This Undictated podcast is brought to you by Future Growth, and I'm in Andrew Canter's office. I actually like the look of it, Andrew.
Thanks, Alec. We try to keep it homey here.
Yeah, and I see you've got big bouncy balls and atlases. I think we should take a few pictures of that. But and the subject that we need to discuss today is the proposed changes to the banking regulations.
Right. So the government has introduced what's called the Banking Amendment Bill to basically deal with how to resolve bad banks, how to deal with bank failures in the future. Obviously, that follows on the global financial crisis, where all hell broke loose, banks failed, and basically governments had to bail out banks with quite a lot of taxpayer money. They don't want to do that again.
In this country, of course, ABLE no doubt has had an influence too.
Well, ABLE is just the first test case, right? So this change in regulations has been kind of rolling down the track at a slow pace. The collapse of ABLE, its curatorship, actually is the test case now to see how these things happen in practice rather than on paper.
Have we been following any particular country in the changes they've made?
So my understanding is the proposal of the Banks Amendment Bill follows, broadly speaking, the G20 countries' framework, with some minor tweaks that Treasury and then SARB has proposed for the South African market. And those are the bits that are up for negotiation with existing lenders, because there are some things that might be prejudicial to existing lenders, both senior and subordinated lenders, in the future.
And how might this affect the investors in banks?
Well, if you've put money so first of all, let's differentiate now. In the future, there's going to be differentiation between depositors, people like you and I as individuals, versus institutional investors who put in senior debt or subordinated debt into banks. And I think it's fair to say, to my memory, there's been no money lost by depositors in South African banks for a long, long time, except maybe in the case of some big frauds that blew up. But generally speaking, depositors are very well protected. And in the future, and in the past, so have senior investors. In the future, that's going to change. Depositors like to be treated as super senior and therefore given 100 cents on the rand, up to probably some sort of number or limit. But the rest of the lenders will be taking haircuts on capital, as we've seen with ABLE, where the proposal is for senior lenders to get 90 cents on the rand. And at this point, the debate is, do the sub-debt holders get anything?
But then it must also have an influence on ratings of banks, capital that the banks have got to keep.
Right. So as part of the broad regulatory sweep in the world, banks are required to have more capital. There's more rules. There's more risk management that's happening anyway. But you're absolutely right. If we take a view in the old days that, oh, well, banks are too big to fail, the government will bail them out, I don't really have to worry. And in the future, it's very clear now we have a model for, if the bank gets in trouble, you will lose some money. You have to change your pricing for that. You have to assume that your loss, if the bank gets in trouble, is going to be higher than it was in the past, and therefore the yield has to go up. That is to say, the bank's cost of borrowing from institutional investors is going to rise, and further, they have to have more capital according to regulation. And as a consequence, basically, the cost of debt to consumers must rise. So if maybe pre-financial crisis you could get a home loan at, prime -1, well, now it's going to be prime plus a half, or prime +1. It's going to be a sea change in how the consumer accesses finance and his relative cost of finance.
Do you think it's going to make any difference to the way that banks lend?
I don't necessarily think so. I think that's a separate engine. It just goes to how they price for the loans and their return on capital. So I don't think it's going to change the way they lend. Although I must say, I think it opens up gaps for various kinds of alternative lenders. While we think that African Bank proves that alternative lenders are going to fail, I think this, because banks, the burden of regulation, rising cost of capital, is going to cause more alternative lenders to pop up. We've seen peer-to-peer lending internationally. We see all sorts of various kinds of alternative lending schemes in South Africa. We've seen from home finance to car finance to bicycle finance, if you want to finance your bicycle, to financing solar rooftop panels. There's all this stuff coming, and it might eat away at the bank's market share.
Securitization, I was thinking as well. SA Home Loans has done pretty well in South Africa, but hasn't really kicked on as aggressively as you might have thought. Would this help?
Well, okay, so with the financial crisis, people are in the securitization structures, which looked nice and robust and safe, actually weren't as safe as houses, quote unquote. And so they remember, you can't run a securitization structure that is making loans unless you can access capital cheaply. And I think that's part of the challenge. As institutional investors became much more cagey about lending, it caused alternative lenders to pull in their horns a bit as well. I think that will change over time.
Get back to the valuations of banks and the ratings of banks from a shareholder's perspective. This has to have an influence, given that for the one part, the banks themselves have to have more capital. Are you anticipating that ratings will improve or not?
So I don't particularly have a view on the relative rankings of banks or whether one should be buying or selling the shares. What I will say is this, is that it became evident after 2008, 2009, that these forces coming to operate on banks would reduce returns on equity, and therefore their growth prospects, and therefore the ratings did go down and have stayed down quite a lot. I don't necessarily see anything's going to change that in a big hurry, frankly. The global pressure still is very much on the banking sector to be nearly a utility of a form, not a wild-eyed risk-taking party place anymore. And if you're going to be a utility, you can have regulated profits. And if they can't regulate them, evidently they're going to fine you to death. They're going to keep sending billion-dollar tickets to you that you must pay. So it's not like I see anything happening in the near term that's going to make banks sort of huge profit engines.
Sounds like a structural change.
Absolutely, and it should be. I mean, the catchphrase is the socialization of losses and the privatization of profits, and that was the problem that led up to 2008, and of course that is a sea change. The fiscus, the taxpayer, no longer wants to bear that risk.
Philosophically, though, and just to build on what you were saying a moment ago, it's moving in the right direction, surely.
Yes, I think it is. And what we were seeing was obviously excessive, and a change was necessary, and the costs and damages done were necessary. I think, and I say this with some trepidation because I'm not a lover of the banking sector. You can go too far with these things. We can end up with a situation where access to finance literally starts to dry up in an economy. If the able workout is mismanaged, it could cause reputational damage to the Reserve Bank in the first case, and to the banking sector in the second case, and that would mean further higher cost of capital, less access to capital, less lending by the banks because the costs rising, more cost to consumer. And I think you can go overboard with regulation and costs to the extent that you actually stifle an economy in terms of access to capital being critical to the development of an economy.
That's a balancing act.
I think it is a balancing act, but I think broadly speaking we're moving and we're close to the end game of the right direction.
And taking it overall, we know kind of which way the regulations are going to be changing. Do you feel that we've now got to the point where even the regulators themselves are saying, okay, enough and no further, or might this just be the start of further momentum in that area?
Well, as I said, I think we're near the end game, globally speaking. Now, of course, in South Africa, the Banks Amendment Bill still has to be finalized, and there are some elements of that institutional investors are very worried about. A bank and curatorship under the Banks Amendment Bill, the curator could do anything he wants. Basically, he can say, "Oh well, we owed you $1 million, but we've just decided it's $400,000 now." Or, "Oh, by the way, we have all these assets, and we're just going to sell them to a new entity at whatever price we determine." And we can change contract. We can just unilaterally change anything without even reference to the existing funders of that bank. And that's a bit hard to swallow, even knowing that it's necessary to move fast and efficiently. It's a hard pill for the current funders to swallow that, oh, sorry, you have absolutely no rights in a curatorship. So I think that's part of the negotiation that has to happen.
It's 6 months on since Able collapsed. With the benefit of hindsight, would the new regulations have avoided that catastrophe? No.
Look, I mean, there is about a half a dozen ways to kill a bank, and one of the ways you kill a bank is with bad lending practices. Regulation wasn't going to solve that. That's business practice. Bad liquidity management, bad asset liability management, fraud, it kills banks. So these things are not things that regulation solves. Regulation seeks to monitor the general balance sheets of banks to make sure that they are robust enough to sustain losses. But regulation isn't going to solve bad business. Let me say it that way.
When is all of this likely to influence the banking sector in South Africa?
Oh gosh, it's happening. It's already been happening. Bank spreads on their listed bonds has been rising. I mean, it's not catastrophic. It's 10, 20, 30 basis points, but it is rising. It is influencing them. I think that institutional investors maybe 5 years ago or before the crisis would be happy to buy 10 and 15-year bonds from banks. And I think there's probably more people realizing you can't really take a 15-year view in the bank. You should be only lending the money for 5 years. And that also affects the bank's ability to make long-term loans for infrastructure projects, for example. Can a bank make a 20-year loan for a power deal if they can only access 5-year finance from the market? And that could be a problem as well. And that is already happening now. that these things are they're slow moving and fluid, and that has been a trend that's already happening. The ratings agents have stepped in and downgraded the banks for the evolution of the picture of how bank failures will happen, and banks will be resolved instead of being liquidated, and it's all coming through the system.
Process sounds as though in time mortgage loans will also become more expensive, given that if the banks are only borrowing 5 years and having to lend it out 20 years.
Well, that's right. That's exactly right. So I used the example earlier about your cost of a mortgage now being higher than it would have been pre-financial crisis. Now, again, I've already mentioned there could be alternative lenders that pop up, and maybe it makes sense for an institutional investor like us to say, hey, you only do mortgage lending, you only do one thing, you do it really well, and frankly, I'd rather you do mortgage finance, and I'll give you money to do mortgage finance rather than give it to a bank where I throw it into a pot of a balance sheet, but I don't know what they do. They're trading, they're trading commodity futures and the bond market, as well as making loans to various sectors and industries. I have a better line of sight to a specialist lender, and maybe I'll even have a lower cost of funding for that specialist lender.
Andrew Canter is the Chief Investment Officer at Future Growth, and this Undictated special podcast was brought to you by Future Growth.